Right, hello again. I've literally just come off the back of recording my monthly update, so it feels like I've just been speaking to you guys. This is a video going to go through the entirety of my investing/trading process. So there's been quite a few changes over the past 6 months or so. So yeah, it's just a video to get everyone up to date with what the process is and hopefully help you understand why I'm doing certain things when I'm doing them. So let's get straight in. I should just say I'm not like a good editor. I'm not on the fancy graphics or anything. So apologies. This presentation is going to be very simple. There's not going to be flashy GIFs or images or edits or anything like that. I'm just going to run through it and show you on the charts. So hopefully you're okay with that. But this is my new investing rules. So I'm just going to run through it and then jump off this sheet to show you examples. So it must score a 36 plus on my checklist to go onto my watch list. So this is the initial screening process, just getting stocks to go on my watch list. So my new checklist, those of you who've been for a while, you know I had an old checklist which was out of 100. I've reduced this to out of 50 and it now focuses purely on financial metrics. So I don't go into, I used to have, let's move this up a little bit. I used to have points for management, if they were good management or if they had certain holdings. I used to have points for kind of geographic diversity, all of that kind of business subjective kind of stuff where I'm researching, deep diving into a company and giving it points for certain things like that. I've got rid of that just because I'm focusing entirely on momentum now. And that's, I feel, more tailored to a kind of value investing type strategy, that you're ensuring that the core fundamentals of the business are sound, that it's going to be around for a long time and it's got good growth metrics and things, which is very important for a value investing mentality. But I still want high quality companies, which this checklist will give me. But I don't feel that kind of fundamental side is as important. So my new checklist is, as I say, based on financials more, to give me those stocks that are set up to be, hopefully, in terms of share price, accelerating and going into an uptrend soon, or finding ones that are already in one. So the first category is earnings per share forecast for the next quarter or half, depending on if it's a UK or US stock. And we're looking at least, to get any points, at least 10%. 10 to 15% is 2 points, 15 to 20% is 6 points, and 20+% projected growth year over year is 10 points. So this is the biggest scoring factor on this checklist. There's no others that give it 10 points. So I'm really emphasizing that future growth, near future growth rate. That's really going to help the share price in the kind of short to medium term. Next I have, so the first three are EPS. Next is a score for earnings per share growth for the quarter or half that has just gone. So when they're giving earnings, the actual results for that earnings. So this is, again, they all start at 10%, and if it goes over 20%, it gets more points. So 10 to 15, 2 points, 15 to 20, 4 points, and 20 plus 6 points. So less than the future EPS, but still some points there. So I'm just going to give everything 6, like the maximum. If a stock, let's bring up an example. So Decker's Outdoor here. This was the most recent snapshot. So this is this area here. This area here, where it's all highlighted in bold anyway. That's the current earnings that they just announced. So EPS 43%, so over 20%, so it gets to 6 points. This up here is the guidance for the next quarter. And you can see their guidance. This is actually analyst estimate, which I'll use, but obviously sometimes on the actual call, the management will say it themselves. But the projected is 25% year over year growth. So obviously over 20%, so it gets 10 points. And then I do for a longer term. So there is still some historical growth factored in here. Earnings per share growth for the trailing 3 years, the compound annual growth rate of the previous 3 years for earnings per share. Again, 10 to 15, 15 to 20, 20 plus. So to find that, there's obviously loads and loads of different ways you can find it. Let's get this all the same. Let's use Deckers as an example. I have a screen set up for it, but you can just look down here, the three-year compound annual growth rate, and it will tell it you for sales, and it will tell you, so that's revenue, and it will tell you for earnings per share. So earnings per share, 3-year, 28%. So that is the 6 points. And then we come on to revenue. So I don't do the revenue forecast because that's less important to me. So go back to Deckers. It's 21% growth. So that will get the 6 points. Oh. And then again, the compound annual growth rate for the previous 3 years, which for Deckers is less than 20%. It's 19%, so we're just off. So that comes in the 15 to 20% bracket, so it will get 4 points. And then return on capital employed for the trailing 12 months. So that's a measure of how well they're using the money that they're investing into the business. So this is usually there's a trailing 12-month column in between these 2 years, which will tell you. If it's not there, you can just either pull that off, so the previous year is good enough for me, or I have the checklist set up where I can go in, position trading screen US, and it will tell me the ROAS for the trailing 12 months, even though it's not on the sheet, and it's 38.4%. So that will get the full 6 points as well. And then the last two are not as focused on growth. So it's liquidity, making sure they've got enough cash to actually run the business and they're not likely to go broke. So I use the current ratio. I'll pull this up so you can see what that means. But it's basically just their assets minus liabilities to make sure that they have enough cash to run the business. So over 1.5, it gets some points. Between 2 and 2.5, it gets some points. And over 2.5, it gets the most points. So very good on that situation. So that's just to judge that they're not imminently going to go broke and that they're reasonably high quality. And dilution. So this is share dilution. So there's a big thing I look out for. So this is Deckers Outdoor we're using as the example. So it had 30 million shares. It's gone down to 29, 28, 27, 26. So that's what we like to see. So they're spending money on doing share buybacks, reducing the amount of shares that are out there to be publicly traded. So if you held 10 shares back here, well, let's say you held 3 million shares back here, make the math easy, so you own 10% of the company. Now it's down to 26 million, and you still own those 3 million. Instead of owning 10%, you own kind of like 12%. So your share of the company is going up. Vice versa, if it goes the other way, which a lot of companies are doing if they're in their growth stages, they're printing more shares, releasing more shares to raise funds to help growth, your share of the business will be diluted. So it doesn't get any points if that is going up. If it stays the same, so if that was 30 every year, just staying level, it would get 2 points. And if they're doing share buybacks and it's going down, as in this case, they get 4 points. So these were both maximum. And then it gives a total points. So for Deckers Outdoor, it'd be 48 points. That's a very, very, very good score. There's not many stocks that run through my screen that get that high. It has to get 36 points or higher to go onto my watch list. Because it still has to do reasonably well to get 36 points. Right, so that's how I find that's the screen to get stocks into my watch list. Once I have done that and it gets the relevant amount of points, I must understand what the company does and know the basics of the business. I don't want to be buying stocks that I don't know what they do. I want to have a decent understanding of what they're doing. So I don't need to be researching it for days. I will just go to their website, I'll read through, get a general understanding of what they're doing. I'll watch if they have an investor presentation, like a dedicated one, a lot of companies do this where it's like a 2-3 hour video where they're just literally explaining what the video comes for, what the company does. I will watch that. If they don't have that up, then I'll watch kind of the most recent earnings webinar, and then read through like some of their annual report and things, just to get a decent idea of what the company does. I'll use screens to find stocks that may potentially score high on the checklist. So I won't have it that they have to have perfect scores, because you won't find any stocks, or you'll certainly not find many. So I'll drop those parameters to like the lowest benchmark, and then manually go through them to find the ones, check them all to see which ones pass the checklist. And once they're on the watch list, I'll fill out earnings snapshots. So that phone's going off. So this is an earnings snapshot. So when they release earnings, I'll go in, fill out all of these sections, re-update the checklist to make sure that they haven't fallen off. So let's just say Decker's next quarter, everything goes to pot. Forward guidance is terrible. They didn't actually grow at all. So it didn't get 6 points there, it didn't get 6 points there, and it didn't get 10 points. Then it wouldn't have the required points to go on the watch list, and it would be bumped off. But I do these and keep these going for every stock on the watch list. I will do a snapshot every time they release earnings. And that is how I create my watch list and manage and maintain the watch list. So once we've got the watch list, my watch list, I just do, so I have a different one for the UK and the US, just because the market times are very different, so it makes it easier for me. But this is my watch list for the US, and I just put all the stocks in, depending on the category, so tech stocks, basic materials, healthcare, financial, industrial, etc. I just find that as an easier way to do it, and it gives me a quick indication of which sectors are doing well or not so well on days and for periods of time. So all of these stocks, at this stage of the process, I'm allowed to buy. But then there's a few more rules that kind of narrow it. They'll stay on the watch list, but narrow it down a bit further. So I can only buy from watch list. The theme or subsector must be in an uptrend. So what do I mean by that? So this is all of the themes, and I don't think it's all of them, but these are most of the themes and subsectors. So for technology, we've got the semiconductors ETF. So these are all exchange traded funds. These are all funds that just kind of have a basket of stocks following certain subsectors to give me an idea of how they're doing. This is the one for next gen connectivity. Not really sure what that means. Next gen software. Internet ETF, cloud computing. So some of these I'm going to be paying more attention to than to others. Robo-robotics, global robotics, and those are all different tech ones. You've got cybersecurity ones, and then you've got healthcare. So you've got the biopharma ones, biotechnology and genome ones. You've got ones that are like healthcare services, pharmaceuticals, and you get the idea, going all the way down for the different sectors, financials, energy, all the way down through to materials. So my rule is, if I'm buying a tech stock, I want the overall tech sector to be generally in an uptrend. So green means it's in an uptrend, yellow means it's going sideways, and red means it's in a downtrend. We haven't got many reds. There's one here. What's this one? And this is kind of going sideways now, but it was in a downtrend. The healthcare equipment. Have we got one that's in a more... Yeah, so this is very much in a downtrend. Self-driving electric vehicles and tech is in a downtrend at the moment. So if I was looking at a stock, if a stock passed my checklist and was on my watch list that was in this subsector, which was focused on self-driving electric vehicles, I wouldn't be allowed to buy it at the moment. I've got to wait for that subsector to be at least sideways, if not in an uptrend. I can buy it sideways if the rest of the sector is in an uptrend. So technology generally is in an uptrend, but robotics is generally going sideways at the moment. But because the overall sector is so strong, I would probably allow myself to enter a robotics stock at the moment. But if it's red, if robotics was in a downtrend, I'm not allowed to enter it. And if the overall sector, technology in general, was sideways or down, then I wouldn't be able to enter if it was down, and I have to be very cautious if it was sideways. But this is something I've only just recently started doing, which a lot of it just comes up again repeatedly with some of the world's best traders, that they really pay attention to this, and it just drastically improves their hit rates in terms of whether the trades are successful or not. It's that old saying of a rising tide lifts all ships, or whatever the saying is. If the overall sector is in a bull run, then the chances are the the stocks in that sector are going to have a better chance of having better growth. And I do the same for the overall markets as well. So like for the US, the S&P 500, I want to see that in an uptrend. The QQQs, the NASDAQ, and then the same with the UK. The UK is a little bit different because so I tend to use it depends what stock I'm looking at. So I mainly have small caps, so I'd be looking at the AIM All Share Index really, which was in a huge downtrend for years, but has now recently turned to an uptrend, which is good to see. But if a overall market is in a downtrend, doesn't mean I'm out the market, but I just have to be a bit more cautious and wait for the absolute perfect setups. So that's that one. The most recent earnings must not be negative growth. So what I mean by that is, so let's take Deckers for an example. So this is the most recent earnings, the actual, if I'm looking at the earnings, the one that they've just released. So yellow is fine. Green is accelerating, so it's increasing from the previous quarter. So the previous quarter was 16% growth, now it's 21% growth. It's accelerating, fantastic, that's what I want to see. Yellow is declining, but still growing. So it's still grown 43% year over year, but it was 44%, so the growth rate has slowed. That's declining. That's okay. What we don't want to see is, so last year it was $3.46. 43% growth, $4.95. But if that was $2.50, so it was an actual negative, the growth had gone down, it had declined, then I'm not allowed to buy the stock. Never buy in phase 3 or 4. So this is the 4-phase system. So I'm just going to draw with a pen. Makes it easier. So the line I'm going to draw is like the share price. So if we're going sideways, it goes into an uptrend, goes like this, goes into a downtrend, and goes into an uptrend. It's going backwards there, but you get what I mean. So phase 1 is the flat phase. Phase 2 is the uptrend. Phase 3 is where it's been in an uptrend and is leveling out. And phase 4 is a downtrend. So we do not want to be buying when it's in a phase 3. So when it's going sideways, we don't want to buy during that sideways chop. And we definitely don't want to be buying when it's in a phase 4 downtrend. We also don't really want to be buying. The only time we want to be buying is when it's breaking out of a phase 1 going into a phase 2, or breaking out. So it can go phase 2 into a phase 3 and then continue into phase 2. It's like a phase 2 continuation move. So we only want to be buying when it's going into a phase 2, basically when it's going into an uptrend. So that's that one. Yeah, so wait for breakout of resistance. Must be above the 150-day moving average. Go back to Deckers outdoors. So to enter, there's several rules to enter. So I'll just run through them all now. The share price must be above the 150-day moving average, which on this chart is this thicker, darker purple line. The 150 doesn't really mean anything. I just have that on there to just for more information. So I'll get rid of that for now. The 150 is the line that I use. So the price must be above the 150-day moving average. The 150 moving average mustn't be in a downtrend. So I don't know if this is going to show us it. Yeah. So here, it's in a downtrend. So as it broke through here, the 150 is actually still in a downtrend. So even if it actually didn't quite get there, but even if it was breaking, let's just use this for an example. Pretend that this isn't here. Even if it was breaking through, because this is in a downtrend, I wouldn't be allowed to enter there. It must be either level or in an uptrend. And you can use a little bit of leeway on that. So obviously if it's here and it's going like this, I would count that as level, even if it was technically in a slight downtrend. The other things that must be happening, so we'll go up to where I entered here. The Mansfield relative strength indicator, so Mansfield RSI, which is this section at the bottom. I'll expand this. So this is the strength of the stock compared to all the other stocks in the index basically. So it's how strong it is compared to the other stocks. So this, ideally, we want it to be positive. So this dotted yellow line is 0. So we want it to be positive. I am allowed to enter if it's negative, but it's got to be in a strong uptrend, which shows that the strength is improving. So we look at that. If this was if at this stage here, this line had been going like this and was like that, I'm not allowed to enter. It's a very weak relative strength. It's in a downtrend and it's crossed into negative. I'm not allowed to enter. Similarly, if it was just bobbling along doing this, so negative but not in an uptrend, I wouldn't be able to enter either. So that must be positive or in a strong uptrend. And also one of the important ones is volume. So you can see the volume bars along the bottom here, and the white line, it's quite difficult to see, is the 50-day average volume. And you can also see, so if you look up here, this shows the volume, these two numbers here. So the white number is the average volume, and it's red or green, depending on if it's higher or lower, is the volume for that day. But you obviously can't see the total volume until the end of the day, so it makes it a little bit tricky. There's a bit of interpretation involved. But ideally, so this is one that's not 100% because you can't tell until the end of the day, but you can often get a decent idea, is I want the volume to be at least 1.5 times the average. So if the volume was 100,000 shares, the average volume, I want to be at least 150,000 shares volume for that day, just to show that there's actual buying demand coming in. And big volume spikes usually indicate institutional investing. So like the big players, the big funds and things are actually buying shares. That's what gives the big volume, because retail investors can't normally provide that kind of volume. So obviously you can't tell 100% at the start of the day. So this one I entered at the start of the day. So what I'll do is I'll go down to a lower time frame, like the 30 minute. And you can then go to the start of the day. When did it break through? Here. So that's after hours. It confuses me. I hate after hours trading. So this is where it started. Friday 24th of May. Yeah, when did it open? Yeah, this is the open. So I'm just trying to figure out what's going on here. This is the open, these volume spikes down here. So you can see it still does the average for you. So these volume spikes are way up. So the first hour and a half, you've got massive volume spikes. So you've got a pretty decent idea that for the day, it's going to be above the average volume. So that's what I do just at the start. If these volume spikes were right down here, then it's probably a sign that it's not gonna put in high volume for the day. But you can normally be fairly confident off the back of good earnings. So it put out earnings the day before, that you're going to get decent volume. But that's something I look for. And then I also have a rule that if I do enter and it turns out the volume wasn't good by the end of the day, and the volume is kind of like below average, then I'll be a lot more cautious with that entry in terms of how I look after it. I'll probably raise the stop, and I'll be more inclined to take profits. So if it goes up 10% or 12%, so and it's showing signs of weakness, I'll be far more inclined to take profits because it's got a higher chance of falling down. So we've done all of these. Must have at least, yep. Ooh. Oh God, go away. Relative strength can be below. We've done that. Yes, so I would also like to favor setups that don't have nearby resistance. So what I mean by that is this is all clear sky, so that's good. Where's a good example? Here's probably a good example. So if you were entering here, what I mean by nearby resistance is these levels here, where it had prior highs, they will now act as some kind of resistance. So that limits your upside. There's nothing to say that it can't break through like it obviously has done here, but quite often you would go up and either go sideways for a while or maybe even come down and trade sideways between these two levels for a bit before breaking up and going through. That's not always the case, and obviously it wasn't here because the stock was so strong. But if I've got two setups that are equal on most measures, but one has nearby resistance like this, which might have a bit of a handicap, and one doesn't have any resistance, I'll favor the one that doesn't have any resistance. It's just an extra thing I look for. It's not like a hard rule. But if you can see where I entered here, it was going into all-time highs. There's no resistance whatsoever. It's a perfect entry. The other thing about resistance is, so there might have been people, using this as an example again, that bought here, and then they were instantly into a big loss, and then it started coming up, and when it gets back to near those levels, they're looking to break even. They've been in a big loss, and they're like, oh, I just want to get my money back. When the level comes back up to that level, there's high selling volume because people are trying to just get their money back, break even basically. But whereas at the top, if it's breaking into new all-time highs, literally everyone that owns the stock is in profit. So people are less likely to be selling the stock because they're not kind of chasing their losses. So that's my ideal situation, where it's breaking into new all-time highs, or at least kind of new highs for like the past year or two. So it could be that if we put this on a weekly chart, it could be that it was kind of up here a few years ago, got into some trouble, came all the way down, and now has come back up. But that high is so long ago that it's not really on anyone's radar, and most people that were holding from back then have sold since. So it's not kind of the same. So I'm ideally just looking for... Ideally, I'm just looking for no nearby resistance. We've done that one. And then in terms of entry sizes, this is something I'm trying. Instead of having multiple entries, so kind of entering here, and then for a portion of my entry, and then entering, maybe doing 30% of my purchase here, 30% here, and another 30% up here, I'm just going in with a full size position at the start, because I tend to get myself in trouble with where I put my stops and things if I do multiple entries. So I'm just going straight in with 5% positions. So that will obviously adjust as the portfolio grows or shrinks, but it'll be 5% of the total portfolio, initial buy straight away. So it's not an issue really yet because my portfolio is not big enough. There will come a time, especially for kind of like small cap UK stocks, where I may not be able to go straight in with a 5% position size because there's just not the liquidity in the market. That's just something I'll have to kind of deal with when it starts to happen. And it may be that I just, in those smaller cap stocks, I just have to take smaller positions and get what I can. And maybe I do continuation buys to try and build up the position, or I just accept that it's a smaller position size in that particular trade. So this is, I've got two different strategies basically. So there's buying from a phase 1 breakout, and then there's buying from a phase 2 continuation. So I spoke earlier about kind of the share price doing this, coming down, going sideways for a while, coming up. It might go that and then carry on up and then come all the way back down. Excuse my terrible chart drawing. So this is a phase 1. So we could put a box around this. Let's say that I'd been watching a stock, I'd been researching it. I actually really, or during this phase, whenever it's on my watch list. It ticks all the boxes. It's growing well. It's come down, it's gone sideways for a while, so it's not already in an uptrend. I can buy on this breakout here, and I would buy that for more of an investment. So I wouldn't have a target profit. I would just hold, and I would have a stop loss, and I'd raise that along the 150-day moving average. So an example of that would be Meta, where... Come on, load everything up. There we go. I have been holding since down here, and I've ridden it all the way up. And I've been raising the stop loss as we go along the 150-day. And I'm over 170% in profit now. And I've already taken some profits up here. So that'd be it's still kind of trading because you've got stop losses and things. But it's long-term position trading. I'm holding that as long as it's in an uptrend. Where was I? Was I on Deckers? Oh no. Oh yeah, I was. If it's in an uptrend already, so this is what Deckers is in an uptrend, has a little bit of a breather, but then continues into an uptrend. So I'm buying out of a phase 2, an uptrend continuation, then I set a profit target. So I'm not just holding the whole time, because it's more likely to turn over fairly soon if it's been in an uptrend for a while. So I'd have exactly the same entry strategy. All of the things I've already been through, exactly the same entry strategy. We're looking for these sideways boxes, and then we enter on a breakout. But instead of just letting it run and following the stop, I'll have a set profit target from a continuation. And that would normally be around 25%. But it will depend on the situation. It might be less if we're in a bear market, or if there's nearby resistance or something, then I might set it to 20% or 18%, whatever that nearby resistance level is. But I will set a specific profit target. And you can see here, because Deckers has been in an uptrend for a very long time, it's set up here. So this is a phase 2 continuation entry. I've set a profit target of 25%, which is this green line. So when the price hits this line, I will sell and lock up 25% gain. So the reason behind this is it gives me the best of both worlds. It means, especially when stocks have been running for this long, I don't want to get greedy. I don't want to let it run, because it's more and more likely to turn over and go into downtrend the longer it's been an uptrend, obviously. So I'm locking these profits, getting profits locked in, but it also gives me exposure to the really long-term multi-bagger moves if I manage to get in at the lows. And obviously, if it's in a long-term uptrend like this, I can still, and I don't catch it at the bottom, I can still make a lot of money, because let's say this goes up, I sell here, it comes up, and then it does another sideways action and then breaks out. I can enter again and make another 25% and do it multiple times on the way up. And there's a lot of stocks on my watch list, so I can do it with lots of ones jumping around, constantly making 20-25% gains. And then I have stocks like Meta, Microsoft that I've entered at the bottom, and I'm holding for the long-term moves, and I give them a lot more leeway. So that's my 2 ways of doing things. And then I should talk about the actual stop loss. So if we go back to Meta, and I would still have the same stop loss rules for both of these strategies. But I'll go to Meta because we've got a big long uptrend that we can use here. So I have talked through, this hasn't changed. I've talked through this lots of times, but as I'll run through it in this video, so we've got it all in the same place. So let's just say this isn't actually where I entered. This was when I was buying on value investing strategy. So I was buying in a downtrend. Turned out well in the end. But this is where I would enter with my new setup. We've kind of put in some setups here. The moving average has just gone sideways. It's broken above the moving average, broken above this resistance, and it's got loads of volume. I'll punch in a bit so you can see the volume spike, but a huge volume spike, broken above this line. That's where I would enter. On the entry, I would have a 10% stop loss. So we would have just held out there. So the stop loss would have been literally here. And you can see, obviously 10% is quite a common stop loss. It came down, tested it, tried to shake some people out, and it started moving higher. So if that had come down here, we'd have been out. We sell. But as it happens, it came down, touched it, and has started moving higher. Now we would use the 150-day moving average as our stop. And what we would do is every time there's a pullback in the share price and then a move higher, we would move the stop loss to the point. We'd take the low point there and we'd move down to the 150. And that would be our new stop loss. We'd let the price continue. Next time there's a big pullback, we'd wait for the price to continue to move higher again to prove that that's kind of a low point. And then we'd move it up to the next point that touches. And we just keep doing that, and that's our stop loss. So up here, this had some big moves, so we'd move it up here. We'd probably do this one here as well. Had a huge gap up here. And then, so next time it pulled back down was here. But you can see we're giving it lots of room to move. We're making sure when we're in these high quality stocks, we've done the research, it's passing, and obviously each time there's earnings along this way, we are doing the earnings, we're updating the checklist. If at any time the stock falls off the checklist, then we may consider selling if it falls off a lot. But if it is just a couple of points short, then it's something to consider, and we'll have a much closer eye on it. But I'll just be doing that all the way up. One thing I will be inclined to do is when a stock starts to lose some steam, like Meta, and it starts going sideways for a while, and it's lost that punchiness, I may pull the stop above the 150 and tighten it up. So here, because we've been in a sideways action, instead of pulling it on the 150, I've put it right under. And a good example of that actually is Microsoft. If I wait for the things to come up. Yeah, so it's just kind of the same as Meta really. But instead of having the stop down here, I've pulled it right up to the low of this kind of sideways action. Because once we're in a phase 3, it could turn into a phase 4 in the downtrend, and we don't want to give too much profits away. So yeah, I'll tighten it up once it starts coming into a confirmed sideways action. But that's how we use our stops, and that's the same for all strategies. That's how I'll always be doing it. And once it runs through a stop, then I sell and I'm out. And that has two benefits. For the investments, the position trading, for the longer term ones, it allows the stock to move. So we get more of those long-term big moves, like 100, 200, 300% moves. It means on our entries, we're never risking more than 10%. So obviously, it may be that stock gaps. The mic's not going to work from too far away. It may be that the stock gaps down or something occasionally. There's nothing we can do about that. We just sell instantly, and we might have more than a 10% loss in those cases, but that's just one of the things you just have to accept. But it does mean on the whole, we're going to make sure we're not losing more than 10%. And it just gives us an easy to follow, simple rule to raise our stop as we go, and we're not constantly wondering what we should be doing. We just have the stop. If it hits it, we sell. So yeah, that is the rules on that one. This is a long video. So we've just gone through those. And then if the overall market is in a bear market, be far more selective and have tighter stops. Lean more towards trades, so kind of profit targets, 20%, 25% ones. And yeah, sell at a profit target of 15 to 25%. So we're doing more kind of jabs in a bear market, getting in, getting out, just banking some quick profits. So this is just the two different setups for phase 2, the things I've just gone through basically. And then my portfolio finally is, so hold no more than 20 stocks. And I think after a while, once I build confidence in a strategy, I'll actually reduce that to maybe 15 or maybe even 10 at some point. The higher the concentration, obviously, the more risk, but obviously the greater reward if you are successful. So I think 20 at the moment gives me plenty of diversification. If you think about it in terms of risk, it's 5% per holding. So my entry is 5% with a 10% stop. So the maximum I can lose, assuming there's no gap downs or anything, is 0.5%, 0.5% of my portfolio on any one trade. If I reduce that to 10 stocks, so 10% entry, then that risk goes up to 1% of my portfolio per trade. So at the moment, I'm happy with 20, and it's just while I'm getting comfortable. If after a longer period of time, a year, 2, 3 years, I'm consistently successful in this and I'm building confidence in what I'm doing and tweaking strategies, then I may start to reduce. And there will be times when I obviously don't have 20. I might only have, even if I've only got 6 or 7 stocks, it will still be 5% entry size though. So that's what I mean by that. All entry sizes equal, 5% portfolio. And make sure not all holdings are in the same sector. So if I'm only holding 10 stocks, make sure they're not all healthcare stocks. Or not all tech stocks. I am quite heavily weighted at the moment to tech stocks. So this is the stocks I own, US stocks. So we've got 2 in cyclical, 3 in healthcare, and 3 in tech. I'll put it on. This is including UK stocks. So it's a bit more balanced, including UK stocks. So we've got some cyclical, some industrial, some financial, healthcare, but we do have, we've got a big weighting to tech at the moment. And I'm allowed a big weighting to a sector, but just not all of it. So obviously I've got all of these for diversification. And we're weighted to tech because tech is what is performing well at the moment. So we want to follow the sectors that are performing well, because that's where we're going to get the most gains, but just not be all in on them. And yeah, that is a run through of my new investing strategy. It's similar to the old one, but it's tweaked. The main changes being the checklist, so how stocks get onto the watch list, and the inclusion of the alternative strategy of like a actual profit targets, so more true trading strategies on those continuation moves, just to lock in some profits. And I think the balance of those two, the kind of longer term position trading and the shorter term profit targets, swing trading, will probably provide a good balance. But we'll see how it goes. So I hope you enjoyed that. That's quite a long, it's like a 40-minute video. I'll probably edit it down slightly, but yes, I hope that was interesting to people. And as I say, now you hopefully get a bit of a better understanding of what I'm talking about when I'm going through my monthly updates and in my trading journals and things. I'd be really interested in what everyone else's strategies are. If there's anything you do that you think would supplement my strategy quite well, anything you think I could tweak to kind of improve things or not, anything that I've overlooked, and just generally what your strategies are, whether that be a value investor or a kind of a day trader or anything. I'm always really interested to hear about other strategies and techniques and things. You can see like these books behind there are all investing and trading books, and a lot more than that. I've read audiobooks. I read all the different strategies. I've read multiple books on deep value investing, and all the way through to day trading, like trading bloody 10-second candles and things. I read across it because I'm interested in all of the strategies, and I think they all have influence on other strategies to a certain extent. So I hope you've enjoyed the video. If you have, please consider subscribing. I'll be doing monthly portfolio updates, so you'll constantly see this strategy in action. I'm very open with all of my trades. It's all open. You'll see all the trades I make, all of the losses I make, all the gains I make, and I will be, no doubt this will get tweaked further. My strategy is constantly evolving while I'm trying to find what works best for me. And I've just started doing weekly trading journal updates, like text updates, blogs that I post to my website, and I post them on Twitter as well. So if you're not already, then consider subscribing and following me on Twitter, well, X, X as it's now called, and drop a like if you've enjoyed the video. So thank you for watching. I hope you all have a great day, and I will speak to you soon.